Three, two, one. Hello, and welcome back to another episode of Word Wednesday. I'm your host, Paige Goodger, and as always, we have Vix Weir from rotoruta.com. How's it going, Vix?
Things are crazy, absolutely lunatic crazy, never been crazier. That means it's great here on the road to Ruta.
So, if you tune into what's going on in the market from time to time, you may start hearing about animals. Bull markets, bear markets, so and so is being bullish or bearish with their investments. So, what do these terms mean? These terms are used to describe whether the markets are going up or down for a prolonged period of time. A bull market is when stocks are rising, prices are rising, and investors are feeling confident. And a bear market is when stocks are going down, prices are going down, investors are feeling maybe a little bit more pessimistic. But don't let the look of a typical market fool you, even if it's going up and down and up and down and up and down. As long as the next lowest point is higher than the last lowest point, that market is still going up and would be considered a bull market. So, why do we call it bull market and bear market? Well, no one really knows, but it's sort of a consensus that the use of bull and bear comes from the way that they attack their opponents. So, bulls start low, they charge and they thrust their horns upwards into the air, right? So, rising prices. Bears, on the other hand, are up and they slash downward at their opponents. So, the prices are going down. Bear claws the market down, bulls toss the market up with their horns. I also like to think of this as the bulls charge, so they're increasing in speed, so it's increasing. And then bears typically hibernate, so they fall asleep.
That's awesome. I love that.
So the origins of these words, no one really knows. The origins date back to 18th century England and something about bear skins. If you really want to look into it, search the South Sea Bubble and the monopoly Britain was granted on all trade to South America. It involves people agreeing to take over large portions of government debt, government corruption, insider trading, and all of these other unscrupulous practices by certain shareholders. So, you know, nothing's really changed.
It's been a long time, but nothing ever changes.
A common misconception is that bear and bull comes from the Barings Bank and the Bull Teal Bank because the Barings Bank were more conservative with their investments and the Bull Teal Bank were more aggressive with their investments. But both of these banks were founded after the terms bull and bear were used to describe the market. So this is not true. So now that we know what it is, we know the origins of these words, and we've debunked some misconceptions. Let's take a look at what we look at on the Road to Ruta side of things. Are computer programs used to rig the markets, and does this have any correlation with the bull versus the bear market that we might see?
Absolutely. And you'll hear people saying, well, you can't, yeah, manipulation's out there, but you can't reverse a trend. And that is not true at all. And we saw it with the silver market in 2011. What happened in 2011 is Barack Obama knew there was a problem with the JP Morgan silver position that short silver position that took over from Bear Stearns. So JP Morgan stuck this guy named Bill Daley as Obama's chief of staff. And what he was doing there was actually rigging the silver market to artificially create a boom in price up from $20 to $50 in early 2011, and then crash the price down from $50 back down to $20 over the course of the year. This started an artificial bear market in the price of silver that continues today. Now we're just starting a new bull market, but it has yet to really get its legs moving very fast. But you can absolutely create bull markets and bear markets with computer programs if you control the vast majority of trades, which of course JP Morgan did at the time, and other entities to do too at certain times. The number one rigger of all markets, though, is the U.S. government with the Exchange Stabilization Fund, which has unlimited amount of money, unlimited. And the reason it's unlimited is because they can use derivatives in these markets instead of real cash. real fake fiat money, but they can use derivatives in unlimited amounts. That's why you see quadrillions of dollars in derivatives. Is entities like the Exchange Stabilization Fund can throw any amount of silver derivatives at the market to destroy the price.
So, even if bear markets and bull markets are artificially created, in your opinion, is it smarter to invest in a bull market or a bear market?
Yeah, I mean, if you knew when, obviously, for a bull market, the bottom of the bull market is the best place to invest. That means basically all sentiment is washed out, and you're going to go up that ramp. The problem is nobody knows, unless you're rigging the market, you don't know when that's going to start. Now, you can also bet on the bear market as well. If you short stocks and things like that, or silver and different types of commodities, you can benefit off a bear market as well, which JP Morgan did. When JP Morgan put Bill Daley in Obama's office, they bought a lot of silver early in 2011 and then drove the price high, and then they sold massive amounts and drove the price down. So they were one on the going up and they won coming down. And that's how market manipulation is so profitable for these banks. It's crazy when you lie, cheat, and steal. Yeah, it's pretty easy to make money.
Yeah. So, if the market has been bullish for a while, is it not smart to invest because they typically jam that price down?
It depends. It depends how big the bull market's going to run, how long the bear market will go, and how long the bull market will go. Nobody knows unless you're rigging. So there are signs that bull markets have gone too far, and that's usually what happens at the extremes. It either goes down too low or up too high, and there are signs. You see that in all kinds of stocks, bonds, commodities, cryptocurrencies. When your local taxi driver starts saying buy Bitcoin, I'm getting Bitcoin, you want to think twice about whether or not you should be lightening your load a little bit, because everybody and their mother thinks it's going to do well, and that's when the market manipulators really attack it too.
Do you think that these bull and bear markets loop people into this fake system that is controlled by computers and derivatives?
Absolutely. But it's not necessarily the market that's doing it, it's the manipulators that doing it. They not only manipulate price, they manipulate sentiment. For example, in 2019, when the Bitcoin bubble, as they called it, was happening, all the news networks were saying, "Oh, everybody's got to buy Bitcoin. Yeah, you're going to be left out unless you buy Bitcoin." And that's when I knew something was up, and they rigged the market lower. Now, this was the U.S. government rigging the market lower in 2017. Is it 17? Yeah, 2017, beginning of 2018. The U.S. The head of the CFTC came out and said, we had to pop the Bitcoin bubble, otherwise it would have just kept going up. Well, what's a free market? If an asset is undervalued in a free market, it's supposed to keep going up until it gets overvalued. You don't have the government come in and pop bubbles because they don't want it to run. They don't want people to make money, so they're going to run in and cause a free market value to be destroyed. And that's what happened in 2017, 18. The guy's name was Chris Giancarlo. He admitted that the Trump administration did that. And all the crypto people were like, what the hell? I thought we had free markets, especially in America. No, we don't, unfortunately.
So, how are they able to do that with Bitcoin if the whole basis of Bitcoin is a blockchain and transparency and not being able to manipulate the cryptocurrency? Where does that come into play with them manipulating the price of Bitcoin?
Well, that's the beauty of the blockchain, is that you can see the manipulation. On a blockchain, you can see where every trade actually happens. And then if you look at the exchanges and you see these volumes that are literally 10 times the total amount of coins that are out there, none of these trades are happening on the blockchain. So the beauty of Bitcoin was we knew that there's massive volumes going through the system with very little blockchain activity. So it was all fraud. I wish we had that in silver on the COMEX, because it would be easier to see the fraud. if you knew exactly how many physical transactions were actually happening versus the derivatives. On the blockchain, it stares you right in the face. And as long as people participate in these exchanges that are rehypothecating assets, you're going to get the same thing. What we need is decentralized exchanges, and that would take the bad guys out, the manipulators out. It's coming, but it's a little ways away.
And then once we switched over to that, the bull and bear markets that we would see would be true bull and bear markets and not the click of a mouse and a computer program rigging it for specific people like JP Morgan so they can make money to pay for all of their crimes.
Yeah, I mean,
Essentially.
yeah, that would be. I mean, ideally, that's what we'd see. Now, there's always going to be ways to manipulate any market, but the power of these manipulators to sell assets that they don't own is the real farce that's being played. And if we had decentralized exchanges, you could drive the price down, but you'd have to sell real assets to do that. And it's amazing how bankers don't want to sell real assets when it's the real thing they're going to lose. So they're all into making money up or down or sideways. So I don't think there will be a lot of naked shorting going on in a truly free market where there was decentralized exchanges.
So sometimes you talk about a 50-day moving average and a 200-day moving average. What are these moving averages referring to, and how does it relate to bull and bear markets?
Well, those relate to the price of the stock and where they close every day. So a 50-day moving average, you just take the average of the 50-day stock price, say it's
Mhm.
going up from, $25 to $30 over 50 days, and you take the average, you do that math problem that you did in high school. You take the average, and those are calculated. A lot of stock traders will look at those and say, okay, if it goes over the 50-day moving average, that means it's more in a bullish type of mode. I want to buy it then, right when it passes the 50-day moving average, because it's going to have momentum. And then I want to sell it when it comes back down. And that's the way a lot of these technical traders will look at how to trade the markets. Problem with technical traders is you're pretty much guaranteed to lose because of all the manipulation. The technicals go right out the window when companies like JP Morgan had unlimited amounts of stocks, bonds, cryptos to sell at any time. And they play with the moving averages. So you can have everybody's looking at the 200-day moving average saying, boy, if silver only broke out of the 200-day moving average, it breaks out, everybody dives in, and then they slam it and steal all your money again. And it's only when that people are really down in the dirt and have no money left do they allow the bull market to start in earnest, and they can make money at it. So it's a game, it's a scam, just like everything we've dealt with on our Word Wednesday discussions. It's sad, but it's important to expose it because it should end.
You had a great talk on a panel you posted a couple days ago, and there was a lot of talk about bull markets, bear markets, being bullish, bearish. So if you haven't watched that video, make sure you go check it out. It's with Andy Sheckman and our friends over at Miles Franklin. So can you explain pullbacks and if they are due to computer program rigging?
Yeah, they can be. And the interesting thing about price for investable assets, when they start running high, everybody wants in. It's kind of the opposite of what you should do. I mean, you should be selling high and buying low, but human nature is that once something starts running, everybody runs after it. And so a pullback would be something like the price of silver starts going up, and it blows by all the moving averages, and that's when everybody starts getting in. And then a pullback would be it's like a sharp drop back to reality. And then, because a lot of the smart traders won't buy when it starts moving really fast, they know the weak hands are getting in, and they wait for a pullback to get in if they still think it's going to go up. We're going to see a lot of that, especially when silver is freely traded one day, hopefully. And the real big money is going to wait for the pullbacks. But sometimes pullbacks don't happen until it goes way. You just don't know how high it's going to go. And with an undervalued asset like silver that's been held price suppressed for 170 years, you're not going to see any long lasting pullbacks in the run for silver to $800. I don't see any pullbacks. So we'll see what happens.
Yeah. So, what would your advice be to new investors who might be looking at the market specifically? It's bearish, it's bullish. What would your advice be to them about when they should invest and what they should invest in?
Wow, I mean, obviously, if you understand, number one is understanding what you're dealing with. If the market is fully rigged, you're going to have a problem ever understanding why price goes anywhere. But at the same time, you want to buy when other people are selling, and you want to sell when other people are buying. And as long as you keep that in mind, if you see something that's going up and everybody's crazy about it, you're probably better off waiting. And vice versa. You see something going down and everybody's like, oh my God, I got to sell my Bitcoin. That's probably a pretty good time to buy. You're never going to catch the bottom, and you're never going to sell at the top. So the best way to do it, I think, would be dollar cost average, which means put a little bit in at a time. If you have $1,000 to invest, do $100 a week type of thing. And then that way you're going to get you're going to get some great purchases and some bad purchases, but you'll get in at kind of a medium level. And then, do a lot of homework and try to figure out why you want to even play in these markets anyway. You got to love what you're doing. And if you see something that the rest of the market doesn't see, and you think they will in the near future, that's the really good ones.
Yes. So, is there anything else about bull or bear markets that you think people should absolutely know?
I would say just know that everything is rigged right now. It won't always be rigged. We will have free markets in the near future, I believe, after a nice little crash, because everything is so manipulated right now. It's got to go away. Decentralized markets are the future, which is peer-to-peer transactions. So if you're going to get linked up, not through a brokerage house or a bank, but to another person who wants to buy and sell a commodity or a stock. That's the future, and the future is not these market rigging banks.
Agreed. Well, whether we are in a bull market or a bear market, it's always important to one, keep your assets in your own possession, two, trust yourself, three, trust your sources, and four, your research. At the end of the day, no one really knows what the future holds. And to learn more information about market manipulation, silver, gold, bullish, bearish, all the terms, all of the things, visit www.rotruda.com. And thank you so much for tuning in to another episode of Word Wednesday. We will see you next week, and take care until then.